Hello and welcome to Moving Market Podcast. I'm J.R. Gondeck, as always, joined by David Sokolovsky. David, let's review, month of July with markets at record highs, give or take in a lot of cases, a lot going on, and review what's happened in August, rest of the year.
Yeah, Jared, thanks. So, month of July, not super exciting. A lot of volatility, but most of the indexes ended up relatively flat. We'll get into some of the details there, but the start of the month of August has been very strong, and markets continue to move to all-time highs. So you've seen the S&P 500 and Dow both reach record highs. We also had a Federal Reserve meeting in July. We'll talk a little bit about that and where rates are headed, but for the moment, they left rates unchanged. And then earnings have been very strong, so companies have mostly reported, and the earnings have been positive all across the board. Um, but there was an interesting bit of volatility, and we saw a very large hedge fund with about $60 billion of assets really implode in a matter of weeks. And that just kind of reminds us the importance of risk management, especially in these momentum markets. But as you look at the S&P for the month, it was roughly flat, down less than a quarter of 1%. You see the equal weighted index continue to outperform. And so again, as we look at the market activity, equal weighted index, continues to do well this year. It's the first time in a long time, but you're starting to see the breadth of the market, really pick up and drive the rest of the market performance. And again, as you look at some of the other areas that have done particularly well, emerging markets, we're down 6% for the month of July. High dividend stocks were the best performer, up over 3%. And then interest rates, continue to edge a little bit higher as the Federal Reserve is contemplating, potentially increasing interest rates. So, Jared, you want to talk a little bit about the Federal Reserve and kind of what that meeting
If
held and some of the key takeaways?
if you look at the Fed, David, they're in a tough spot, right? And if you look at the voting, this this particular meeting in June, you had three dissenters that chose to vote to raise interest rates. It surprises me a little bit. I would have expected this in the month of June because month of July we had, positive inflation data. So in theory, inflation looks like it's moving in the right direction. Despite that, you had, three dissenters, right? And now as you look at the labor market, right, surprising number on Friday where the labor market lost jobs and then the adjustments backward were minus, give or take 100,000. So if you look at the last 12 months, we've averaged about 25,000 jobs a month, right, which is relatively low. So with that, the expectations in the market have, moved or pushed out the expectation for the Fed to raise rates. September a week or so ago was more than 100% probability. Now it's less than 50%. And again, for me personally, I think you got to watch Warsh. Morgan Stanley had a report out last week for the first time talking about the Fed cutting their balance sheet, which again is a topic we've talked about. So you could see the Fed, and it's more of the base case I would expect is the Fed to cut the balance sheet as opposed to raise rates to curb inflation if they're really concerned about that. But again, the challenge you have is where do you go from here? If the labor market's weakening, we'll see. And this week you have, consumer prices and producer prices again this week, which expectations are to be a little bit muted. But for me personally, I think you'll probably see, higher than expected inflation. But nonetheless, we have to see where things are going overall. But to the point, the market kind of sold off on the Fed and kind of came right back. So the market seems to be shrugging things off overall. And then you talked about the situational awareness hedge fund, David, right? I mean, it's just when you look at some of these momentum stocks that were up 3, 4, 500% this year, you could see the types of names that and hedge funds pushing this. And, they're reported of 4 times leverage, is a little bit spooky. And you could see the impact of that. The market moves against you and you go from being up over 400% the first half of the year to liquidating your entire portfolio in 3 weeks. I mean, it's crazy from that standpoint of being careful on where things are going. And then Jamie Dimon mentioned this, as a cautionary note that, you can see other hedge funds that have a lot of leverage that could be a concern for the markets overall. Because at this point, we're not overly concerned about the leverage, but the prime brokerage, can extend much more. So, for example, if you put up $1 billion of collateral, in this case, like situational awareness, you were able to invest $5 billion of assets, right? And you can see the challenge for that. The market moves 10% lower or 15% lower, you're basically wiped out on your portfolio. And that seems to be the case here. But overall, I mean, you take a step back, the economy seems like it's moving along. Expectations for third quarter are very positive on GDP, right? And we'll see where inflation goes from here. But like I said, to me, I don't see the Fed raising rates. The earliest for me would be December. And again, it gives you a lot of data for the Fed to analyze between now and then.
Jared, can you go maybe take a step back? You mentioned that there was over 100% probability for folks listening. What does that mean?
Well, if you look each Fed meeting, there's an algorithm that kind of tracks where interest rates are and what the market expects the Fed to do. And if you look historically, it's been relatively accurate. Obviously, it moves day to day, week to week, in some cases a lot. But in general, it's something we followed, for years. It's just a general indication. So, like I said, a week ago, the market had fully priced in the Fed to raise rates, right? After a week data point on labor on Friday, it got cut in half. So you can see how this whipsaws, in the short term overall. But again, it's a general guide of where the market expects the Fed to go with policy. We'll see if this changes because one of Warsh's movements is to be a little less transparent to the market as far as communication and such. And again, I can understand, his frustration if you have a committee that you're trying to tell the market what to count on and you have three people that have the opposite view. It's not really a uniform, you know, view to the markets overall. So I think over time you're going to see less and less communication from the Fed and Fed governors overall to try to have more of, one view to the market as opposed to multiple.
Yeah. Um, so Jared, if we, I guess, take a look at kind of market activity, we talked about companies and how they performed last month, and obviously a strong start to the month here. But as you look at earnings, you see some of the companies perform really well, particularly chip stocks, right? And immediately after earnings, you see, they beat earnings expectations, they beat revenue expectations. They might have 50% growth year over year, right? So you take a look around and those are pretty strong numbers. Why would you see stocks sell off immediately after such good news?
Well, it's the old chicken and egg, right, David? I think is a lot of the concern, from the market standpoint is if you beat earnings and your stock was up 200% going into earnings over the prior quarter, you really need to beat by an extraordinary amount and have a much, much better outlook in a lot of cases. And this, you look historically as you start to get companies like that, maybe there's that shift going on within the market already, because again, the market's always forward looking. So as you're pricing in stock performance, despite the fact that you raise the outlook, it's not enough when you look at valuation, or in some cases, even the beat is a slowing growth rate, and that slowing growth rate can be a problem for the multiple overall. And when you look at, there's a lot of concern that the market was overpriced. But as you start to look at the multiple, the S&P forward looking, the market's kind of grown into the valuation, right? The earnings have really picked up. The forward PE in the S&P is around 19 and a half, which, going back a quarter or two or three, we're in the middle 20s. So despite the fact that we're at record highs, earnings have justified where the market is at this point. And again, as you look at some of the rotation, we've talked about this the last few months. I mean, there is good value in the breadth of the market, and you're starting to see that performance pick up kind of everywhere else.
Yeah, so as we look around, I guess towards the second half or really the back half of the year, what are some of the kind of approaches to protect the value that's been created and also to participate? I mean, we saw a little bit of maybe FOMO, fear of missing out from Warren Buffett starting to deploy some cash after 14 quarters, of really just growing the balance sheet and growing cash on the balance sheet. So what do you do to protect? And is this the right time to kind of jump all the way in?
Well, if you look, David, we're kind of in no man's land from, we're through earnings season now. There isn't a Fed meeting this month. There, not too much economic data for the next few weeks, and quarterly earnings now are 7, 8 weeks away. So, where do the markets drift from here? So I think as you look around post earnings season, taking a little bit of profit has been the case. We've talked about this all year of staying diversified, right? And move. And I think within kind of the breadth of the market, I think that's where there continues to be a lot of rebalance opportunities. Overall, the challenge is many portfolios, how do you pay the taxes, right, and stay diversified? So I think a lot of investors are generally hesitant to take a lot of profit and move within it. But I think, as we look at individual portfolios and individual cases, there's a lot of planning ideas that go with, planning for capital gains, because to us, our philosophy has always been to take a little bit of capital gain over the years so that you're not too concentrated in one name overall within your portfolio, because then it could be very difficult to diversify because the gains become larger and larger over time. So I think, looking at really a lot of areas within the market, industrial names have done well, financials have done well, right? And valuations are still looking pretty attractive in a lot of cases. So I think, we've talked about the five-layer AI cake, of investing. So I think there's just different approaches to, get exposure and maybe not chase the momentum and still have good returns between now and the rest of the year as well.
I guess we'll be looking forward to the inflation reading. We're getting that later this week, and that should give us some clarity on kind of what the Fed is going to be looking to do. And kind of as you mentioned, JR, it's likely to be higher than expected because of ongoing war with Iran, especially last month with oil prices jumping. But outside of last month, obviously, as we saw in the prior month, inflation improved, and again, it'll just be a core area to watch because between the two mandates of the Fed, you have inflation, which is price stability, and full employment. Employment looks pretty good. It's not as maybe as good as we'd like to see, but overall, still in okay shape. Inflation continues to be the area of concern. And again, as we see, the Federal Reserve adjust their approach, and whether it's raising interest rates or tapering the balance sheet, we'll see what the impact ultimately is.
Well, the other thing that's interesting, in this cycle of the market is first time I recall a lot of big companies selling stock for capital expenditures, right? You've had a number of very large companies, you know, issue stock to fund growth. And if you look at a lot of the potential forecasts ahead, you could see dramatic GDP growth over the next number of years, on this AI build out and such. So it's definitely something to watch for and be aware of. And again, at this point, it's good for investment bankers. It's good for a lot of the big financials, all these underwriting, fees. I mean, the debt markets are fairly massive at this point as well, and again, something we're watching for in, maybe the next 18 to 24 months. I think the bond market could be pretty compelling, depending who are the winners and losers with some of this AI build out, because I think there is going to be opportunity on the ones that miss on this within it overall. But again, I think from our standpoint, we're in pretty good balance. The markets seem to be, in good shape, and now we're just watching Federal Reserve to see where things go from here and, make any adjustments accordingly. So with that, I want to thank you for tuning in. We'll touch base next month.
Thank you.